So welcome, everyone. And I think we have most of the people so far let in. As you know, our board members come right at the moment to get onto a webinar. Good morning, and thank you for attending today's BRC webinar. I'm Kathy Allen. I'm the founder and chairman of the Board Risk Committee. In a moment, I'm going to introduce the speakers, but first of all, I've got several housekeeping notes for you. As we said, this is going to be recorded and available on our website after the program. So again, you can share it with your other board colleagues or people that might be interested. I know we've already had a number of calls of people that can't be on the right now, but want the recording. Secondly, use the chat feature. All of you are muted, so the way that you communicate with us is through chat, typing into chat the questions you might have. And as Susan moderates, she will have different times that she'll try to integrate those questions in, and then we always leave about 10 to 15 minutes at the end to answer questions as well. Today's title is Boards and Risk, Asking the Right Questions. We have two outstanding speakers, and again, Susan moderating for this. For those of you that don't know, the BRC is a thought leadership peer council. It's for corporate board directors, CEOs, and chief risk officers. We're nonprofit, we're non-competitive. We do a lot of joint webinars with women corporate directors and NICD and the Corporate Board Forum. Our focus is primarily on risk, helping board directors understand the risks that are out there, everything from geopolitical to reputation risks to cyber to AI, and also helping people to understand how to talk about it at board meetings. And a lot of that's going to be the discussion today. But also how to handle the risks that we're facing and to understand this is a critically important, not only for the whole board to discuss risks, but to consider having risk committees or technology committees of the boards. We are going to have links on chat on how to stay engaged with us for future webinars or our board risk reports. And sorry, I've got allergies. My voice is not very good. And also for the questions that you might have. And you'll find there's usually a dialogue between the directors that are attending these webinars. I'm going to be introducing Susan Keating, who is our CEO. She's had extensive experience in financial services, serving as the first woman president CEO of a major bank, Allfirst. She's also sat on a number of boards. She's been in financial services for the last 29 years. After being CEO of Allfirst, she was CEO of the National Foundation for Credit Counseling, and most recently of Women Corporate Directors. So Susan is well versed in the issues around boards and also the risk issues that financial services and other corporations face. So Susan, I'm going to turn it over to you to introduce our guests and to moderate this.
Going. Thank you, Kathy. And Kathy, as I think you all know, is the founder and the visionary for the Board Risk Committee. And as always, it's a pleasure, Kathy, to work with you. This is an important topic today. I think all of us know that we're operating in a world that's just changing at an unprecedented rate. There are all kinds of risks, threats that are coming at us from all different directions, and really ones that we don't have necessarily past experience in. So today, a robust risk framework in companies is absolutely essential, and leadership has to elevate risk awareness and engage in risk analysis, reporting, and so forth throughout the company. As I like to say, everybody within the company has to be a risk professional these days. This webinar, we are so delighted. We have two incredible professionals that have extensive backgrounds in risk. They're going to provide us with some very practical information and some guidance and help us sort of think through, as senior executives and board members and so forth, how to have a most effective risk culture within companies. So I'm pleased to introduce Mark Sexton. He is the Senior Managing Director at FTI Consulting, and Financial Services Risk Practice Lead is an advisor to boards, C-suites, and senior business leaders on complex growth and transformational initiatives. He had many years in the risk area. He was previously with Promontory Financial Group, KPMG, and a senior bank examiner at the Federal Reserve Bank of New York. Also with us is Ron Cathcart. I see you there, Ron, who's Managing Director, Risk Practice at Promontory Financial Group. And he's actually a very recognized expert in enterprise risk. And he has an accomplished record in banking and supervision in the financial services industry. Ron, too, was with the Federal Reserve Bank of New York and held chief risk officer positions at numerous financial services companies, including Washington Mutual, Canadian Imperial Bank of Commerce, JP Morgan Chase, and Royal Bank of Canada. So Ron, Mark, you're each going to bring some very unique perspectives to today's discussion. Why don't you expand on those wonderful background? I did a very short, brief intro, but talk about your work with boards and as presenters and members. So Ron, why don't you kick us off?
Well, thanks for that introduction. That's very complimentary. I have basically 25 years in banking at the increasingly senior level, chief risk officer level. And I would say since I started my banking career in 1982, I have probably seen every risk crisis that has occurred, starting with the LDC debt crisis in the early 80s. After leaving banking, I went into private equity for a period of time and participated in the acquisition of some of the impaired banks as a result of the financial crisis. I was a regulator at the Fed, heading up a supervisory team that covered all of the risk practices and oversaw the large systemic firms and these firms regulated by the Fed. And then I joined Promontory Financial, which I left 2 years ago, and I'm now the vice chair of the risk committee of Natixis Financial. So as you've mentioned during my board, I did a lot of presenting to boards as the chief risk officer, and now I get to be on the other side and observe presentations made to directors.
So Mark, how about you?
Yeah, no, thank you very much. That was also a very kind introduction. So one part of my background, and this went back a bit far in time, I think, so we focused on the nearer thing, but I started my career actually in the front office in sales and trading. So I spent 12 years at JP Morgan Chase and later at Citibank. And while today we're going to focus the discussion on risk and the interactions with risk and the board, that front office experience, I've really carried that through both to my examination work at the Fed and then as a consultant, because I think that context of never forgetting that all these things link back to strategy and how you're making money, and sort of having sat in that seat and taken risk, initiated risk, and managed risk from client business really carries through into the work I've been doing since then. So looking forward.
Terrific, Mark. Well, so in your recent article, Mark, you talk about keeping pace with the evolving landscape. So what are the challenges that you're seeing?
Yeah, so one of the big challenges I see, and this certainly gets a lot of press these days, is these risk categories that are now shifting so rapidly, right? So a lot of talk about geopolitical risk, tariffs, sanctions, and export controls. Obviously, technology has always been moving quite quickly, but I think the challenge that makes is these are sort of flick a switch changes that we haven't seen a lot in recent years, where it's creating extreme challenges for board on one day. But even just look at Iran and Israel. Like I don't think people really saw that happening as quickly as it did, nor did they see the U.S. involvement happening in that way. Sanctions. President Trump has made it clear that he's going to use sanctions and export controls to sort of advance his economic agenda globally. So I think those sort of risks and the pace with which they go from one extreme to the other presents some unique challenges for boards. And I think it's requiring sort of a lot more preparation and work ahead of receiving risk information from management, and then participating in the board discussions.
Well, that's great. And Ron, what are you seeing? How are you seeing this materialize in your role as a risk committee chair?
Vice Chair, actually, but I
Vice
will.
chair, okay.
Just-
I just elevated you. You're supposed to
you
say
did.
thank you,
Thank
Susan.
you. I'll let the chairman know. Just to pick up on this issue of the event-driven nature of the environment that we're in, it's very easy for boards to lose sight of the larger context because there are so many things that are coming in over the transom. I can just cite a few. First of all, if you think about financial services, what I would describe as the oscillating regulatory environment. When I was at the Federal Reserve, Dan Tarullo was there. CCAR was created. There was a big reaction to the crisis, and banks were put under a lot of requirements from the Fed. And then you had Randy Quarles, part of the first Trump administration, who backed off on a lot of those, started the idea of tailoring. Then Michael Barr came in with the Biden administration, much more conservative, if you will. Basel III proposals were made, which were untenable. And now we have Michelle Bowman, who will create a new environment. It's very difficult for boards to keep their eye on the regulatory requirements when they shift so dramatically, so quickly. Environmental events, you think about Florida and the problems with weather, California similarly, and the stress that they put on the insurance market. This has caused a lot of evaluations in the financial sector for credit portfolios and across the full spectrum of businesses trying to accommodate these dramatic changes. The political environment, obviously, Mark referred to it, the trade flows, what's going to happen to retail companies in this country, and the oil and gas requirements that are what I would say is some states being very strident about wanting financial advisors to lend and deal with the oil and gas companies. Private equity is a huge emerging issue in the credit markets. There's now $1.1 trillion of private equity in the credit markets in the US. They provide about 50% of the leveraged financing right now for the more highly leveraged companies. And then technology advances. AI is on everyone's lips, but there's quantum on the horizon somewhere. And what does all that do to our cybersecurity capabilities? So there's just like 5 things that are basically confronting boards that take them off their game, which is to think strategically about risk for their institutions. Well, I don't mean take it off the game, but they can be very distracting if you go down any of those rabbit holes.
Ron, very well said. I have to tell you, it just boggles my mind what's going on. If you take a look at the chat, we actually have a copy of Mark's article and the research survey that he did on what's going on with risk. What we'd like to do is actually put up a polling question and just sort of compare your thoughts against what Mark found some 6 months ago. So basically, the question is, which of the following risks would most impact your firm's ability to execute strategy? So we'd love it if you'd pick one.
Yeah, and just to preview some of the discussion we'll have here, is quite interesting to see, because the survey that we did was sort of conducted towards the tail end of Q3 last year and into Q4. So it sort of captures that election period, one side to the next. So certainly interested to see how some of these results. I won't tip my hand on what people said before, but if you read the article there, you will know. So we'll give it a few minutes.
Yep, we'll give it just a couple more. Excellent. So far, nobody's worried about conduct.
No. It's when it popped up, Susan, just on my screen. All right, everybody's seeing it. I just had it too small, so I was only seeing the top 3 or 4 of them, but I see the rest.
And then I notice in the chat that Peter says, I would say that the answer depends upon our practice areas, and that's totally fair. But please,
Yeah.
at the industry and board, said Dana.
Yeah. Yeah, one thing that I thought was interesting, and how are we doing? We've got a pretty good chunk of responses here. Or is that a statistically significant sample yet, Ron? Do you know?
We'd have to know the population.
Yeah, exactly. So why don't I just jump in terms of what we saw? I mean, not surprised to see cybersecurity on there, right? Clearly as a disruptor, and that actually turned up 78% of the time in the responses we got back in the end of last year. What's really jumping out at me is this sudden departure. That was second on the list. Key person risk is what we sort of think of it as, and that got a 70% response rate as a key disruptor. I'm wondering if we have a more varied group of attendees here, because certainly hiring and firing the CEO at the board level is the top, obviously the top thing that they do. So I think that survey was targeted more specifically at board members. So likely, that came in higher. Privacy and data and AI were at 56%. That was the third highest last year. So we do see that showing up. What is it, about fourth on this one, so not that far off. And then, your point about conduct, Susan, is a goose egg here, and that was actually 46% of the respondents last year cited conduct risk as a top disruptor.
So obviously, those that are with us today are with companies where they've got people well behaved and things are going well. Well, let's talk about this. So the risk environment has grown much more complex. What issues are the most complex and what can be done? And Ron, why don't you take the lead with that?
Well, it's very interesting because the first one that I was actually going to highlight was actually culture and conduct. And I think about, Wells Fargo and the extent to which that influenced their ability to grow and has for the last 4 or 5 years had an impact.
So Ron, just mention, since we have a lot of industries represented here, just a quick kind of touch on what happened with Wells Fargo. I think everybody knows, but just in case.
Well, very briefly, they had major sales incentives which caused some behaviors among account officers to open fake accounts for clients who had not asked for those accounts to be opened in order to generate fees. Fees were inappropriately applied. And then there was a whole cascading of issues relating to what you would probably call customer abuse. And the Federal Reserve put a cap on their ability to grow, which was just lifted last month, but it was in place for over 4 years. Yes. So it had a huge impact on Wells Fargo. But I also think about a number of other situations. There was an FX trading problem where many of the banks were held criminally liable. The reason I had it at the top of my list was you asked the question about complex, and it's very, very difficult to get your handle on culture and conduct. Like, how do you create a good culture? And so people attempt, training sessions, tone from the top, disciplinary actions, how they're handled. What role does audit play in relation to HR? It's a very complicated issue because it relates to human behavior. The second one that I would mention is I guess it's disguised as cybersecurity and new tech. I put new tech and cybersecurity almost in the same category. Evolving technologies, I think we all remember maybe 7 years ago, 8 years ago, the cloud was the big deal. Everyone was talking about the cloud. Now nobody's talking about it because that evolved, that happened, everything moved to the cloud. Controls got put in place, and it turns out that was a fairly seamless transition. So now the discussions are all around artificial intelligence, generative AI, and so on, and how that's going to apply to all of our industries and how firms are going to prepare for what that means, both in terms of the impact on their own employee base, but also on the impact in the competitive environment. And then one that you don't hear talked about very often is quantum. And I think everyone recognizes quantum computing is not going to take over from digital computing, but it is going to provide some real challenges, especially in the authentication area, which is going to require banks all firms to rethink their technology readiness for privacy, cybersecurity, data integrity. And the last thing I would say, and I would tell you this is the hardest thing for any board and for any management, is to get a handle on emerging risks. And you hear a lot about stress testing, and the tendency is to stress the things that have already happened because there's a history around how those stresses have impact profitability and the pull that they have made on capital. But what about the things that haven't happened yet but are emerging, that are right there on the horizon, very difficult to quantify, very difficult to get a handle on, and one that is in fact a major board responsibility to foresee. So that would be a quick
Well, Ron,
summary.
that's incredible. And Mark, maybe before I turn it to you, I might just mention, I think many of you know that I was CEO of a bank where we ended up having the largest fraud in US banking history at the time. This was many years ago. And the fraud was $691 million of an FX trader that had burrowed into the company. And I want to go back to your conduct and culture point, Ron. I mean, if you kind of peel everything back, we had one rogue trader operating in a unique siloed division where there was top-down kind of bullying, just very, if people sort of ask questions, they'd kind of go at each other and that sort of thing. And so we actually found that one of the real fixes, the points were really, don't let any division be a silo and different and separate from the rest of the company. You have to all sort of kind of oversee, and don't assume that everybody's going to do the right thing. So, but anyway, we survived that. I survived it, and fortunately we moved on and we had a successful outcome. But Mark, how about you? What are the most complex issues?
Yeah, so a couple of things I'd highlight are sort of tangential or in the background to some of what Ron mentioned. Starting, he mentioned quantum and also AI. Like foundational to both of those is your ability to manage data. And it's not just from an access management perspective and a security perspective. It's like, how can you ensure that the quality of your data and the actual data elements are fit for purpose for any of these new applications you want to apply them to? So that's an area where we're having a lot of discussions with our clients. And then I would also highlight some of the interconnectedness of these risks. So we talked before about tariffs or export controls. And so if you think of yourself in financial services, right? Well, what's the implication to the credits in my loan book for these companies whose business model might suddenly be, significantly disrupted in one of these flick a switch changes in the environment that I highlighted? So you're really seeing that sort of connectedness there. And then another one is like a lot of these become very quickly strategic risks. So when we talked about changes in regulation, Ron highlighted, if you look at something like digital assets, right? For firms that chose to take a go slow approach to that, and we're just going to sort of wait and see how this evolves. When you get such a dramatic shift in regulatory posture towards that industry, then suddenly some firms are left flat-footed, questioning that strategy. Other firms are well positioned to move forward quickly. And sort of that's that connection at the board level between what are the risks of launching quickly into these new businesses, but what are the strategic implications if we don't, right? And that's where you really have to drive that discussion between the board and management and risk, is sort of how does all this fit together for us to execute our strategy.
Excellent. Well, we're going to actually try again on a poll question, recognizing that a number of us have come out of financial services, but many here are in other industries. And I would just say with the BRC, we are seeing more and more healthcare and energy and other companies create risk committees. But what we'd like to know is, does your firm have a dedicated risk committee? And we'd like to see your answer.
And one thing here, Susan, just to preview for people, is you're going to hear a lot from Ron and I about like what you should do and sort of what best practices are and what you can do. But the time is obviously a factor here, right? So what can you actually hope to accomplish, and sort of how do you need to adjust your approach to interacting? So I'm interested to see how these numbers come together.
Well, it's kind of interesting. It's almost split. It's a little heavier, yes. But we should have followed this. Tell us your industry, because it would be, and a couple of you might even comment in chat. If you're not in financial services, what industry are you in? That might be very helpful for us.
Interesting. Yeah. So Ron, maybe connecting this back to a panel discussion we had a while back, right? Is that, even with a risk committee, like time is going to be limited, right? So it's important to know whether, as management and the risk function are presenting up to the board, it's like, to what level do they have to consolidate information? To what level do they have to prioritize, what's worthy of bringing to the board? And I think back, Ron, to one of the on that panel, we had such a range of like available time across the different speakers. So at the one extreme, Bianca, she was at a foreign bank. She got 1 hour with the full board. That was the full board meeting was an hour, but she had to fit in her risk discussion in whatever, 5-10 minutes of that. That was her time. So she had to do a lot of pre-work and with smaller groups to talk through issues. At the other end of the spectrum, Oliver Jakob, he was working for an insurance company. They had 3-day offsites every quarter in the Bahamas, which not only included like 2-hour plus full board meetings, but there were multiple 2-hour sessions where they did deeper dives on risk. So that structure of risk committee, full board, other committees in the board where maybe risk issues are discussed, really dictates what the risk function needs to do in terms of how they choose to interact and share information.
Yeah, I wouldn't be advocating for the creation of risk committees for every industry across every corporation, but I would make a plea for getting people to understand what risk management requires, what kind of oversight it requires, no matter what the board construction. A lot of boards have the risk function or the risk discussion taking place in the audit committee, or the full board even. And in the case of the full board, it can tend to be diluted and in a sense overwhelmed by the profit and loss, earnings per share projection kind of discussion that the full board will have. I mean, just to make a plea for risk management, what we are talking about is unpriced for, unexpected losses that are plausible but don't tend to materialize. Because if they consistently materialize, you'd have no capital. That's the whole point, is that risk management is more about maintaining profitability and survivability than it is about the latest twist in the market in terms of competitive environment and so on. So if you think about the audit committee really oversees audit, and it is an assurance function, and it tends to get tangled in with risk management, which is really all about creating parameters for setting risks, establishing controls, generating reportings, and probably more fundamentally, owning and looking very deeply at risk appetite. And the concern about not having a separate risk stream within board oversight is that risk appetite gets sort of lost in the planning cycle. So it's part of the 5-year plan, but it's sort of embedded and overwhelmed by the kind of financial nature of the exercise. So whether you have the committee or not, speaking from the board perspective, it's really important that the board be able to have a direct dialogue with the second line, with the chief risk officer, to be able to understand the impact that all of the business decisions are having on the risk profile of the organization.
Excellent. Well, looking at the chat, Kristen's in manufacturing, Sharon's in real estate. So it looks like they've got some risk committees. Dana said energy and ed, not so much. And Dana, I'm going to check again because there's one energy company that I was pretty sure does have a risk committee, but I'll check that because I could be corrected on that. So let's kind of move, and Mark, in your article, you touch on how, and what should be prepared and presented to boards, and just how do we disseminate information? How can we ensure that whatever is presented can be done so that it's most effective and the points get across in terms of the risk presentations? So some additional thoughts on that?
Yeah. So just to start, I think I'll just speak to the board, the importance of the board sort of also advocating for how they want to receive their information. In financial services, like regrettably, the supervisors and regulators, I think, have created this paperwork pyramid of reporting from the risk function, and it's become regrettably a cover your backside exercise to some extent, because the management and the risk function can be criticized for not being comprehensive or leaving something out. So in that context, you've got these huge reporting packages that go up to the board, and it's a lot to digest. So Ron can share his experience with that. So that's one way in financial services. Like, as a board member, you're going to get that package whether you like it or not, but you might not necessarily find that the easiest way to digest the information, or you might prefer to have more time spent on discussion. But to the extent that you're going to have to produce a package like that, the real key is like getting the executive summary right, and not just prioritizing the risks that you want to talk about, but messaging them in the right way. To some of Ron's points about strategy too, is you take a particular risk. I don't know. We talk about AI, right? So why are we even talking about this, right? So remind the board of, hey, we've chosen this strategy with respect to AI, or we've noted that it's actually being used across the organization in ways that we haven't even quantified yet. Nor do we understand how our vendors are using AI in their work. So what's the context? Why are we talking about this? And then where does management see the risk materializing for the firm? And what are we doing about it? Like, what potential outcomes have we thought through? And what are the controls we're putting in place? So it's really telling that whole story, concisely, and connecting it back to strategy in a digestible format. So a board can go through the first 5, 6, 7 pages and understand what's most important. And then if they want to sift through 300 pages of detailed data and graphs and charts, they can do that. But that's one of the ways I see most effective, is making that executive summary tell the right story.
Well, and even going back, I'm going to say, Lene, thank you. She was saying in the 90s on whether to invest in or not. One of the questions when they were assessing, she posed, what if we did not invest? In other words, how to challenge and rethink in terms of the thinking. But that's a little bit separate as to what information. But Mark, fascinating. Ron, your thoughts. And then Dana also has, check the chat. She's got good comment there about how risk needs to be backward and forwards focused, of course, which is great.
Well, I completely agree with Mark about what the regulators have done to financial services boards, and it's counterproductive. Because basically they're asking the board to be involved in every major issue. And it's interesting, while I was at the Fed, the people in the Federal Reserve and the Board of Governors recognized this problem, and they actually went and annotated each time in every regulatory letter that had been issued when the letter referred to board and senior management in an indistinguishable way. In other words, as if they were one unitary thing. And this resulted in a lot of studying as to, well, what exactly do we want the board to do versus management? And they ended up issuing what they call an SR letter, which is a supervisory and regulatory letter. The Federal Reserve numbers these letters, and this was SR, Supervisory and Regulatory Letter 21-3. And if you look it up and if you Google it, you'll get it right away. And it's a supervisory governance on board of directors, and it tries to enumerate exactly what a board should do versus what management does. It talks about the board, it doesn't talk about management, but by exclusion, it does. It would be worth reviewing that. It applies to banks over 100 billion, so it doesn't apply to most people on this call, but it is actually a good, well thought through document as to what boards need to do in the area of risk oversight. But putting that aside, it is true that boards get inundated with I think they are awash with what I would call management junk. So some of the consistent weaknesses that you see are dense decks that get walked through that are really just memos with hundreds of pages hundreds of words in size 7 font. The chair will say, let's assume we've all read the material, which of course all directors have. I would say generally directors are very diligent about reading the material. And then the management will walk through these pages that are incomprehensible. They contain elevator analysis, pages and pages of this went up, that went down, this went up, that went down, without any context or explanation. Many pages with traffic lights. This is red, this is green, this is yellow. Look how few reds we have. acronyms that are in the glossary that are very difficult to find, so filled with acronyms. So directors really need to step back and put things in perspective and in context, and identify the major issues rather than getting kind of sucked into this vortex of risk management speak and acronym wilderness. You know, the French philosopher Blaise Pascal very famously said, I've only made this letter long because I didn't have the time to make it shorter.
That's great.
And that is what happens. It's a data dump. So I'm not sure I'm responding exactly to your question, but I think that the biggest challenge boards and management have are to make meetings strategic rather than getting lost in the weeds. I guess that's the headline.
Well, and Ron,
Can I? Oh,
go ahead, Mark. No,
I was
jump
just
in.
gonna say you can tell Ron's on a board now when he says like everybody reads the material, because I've done enough presentations where the glassy eyes and the dumb questions make it quite clear that people haven't read the material. So, Ron, kudos to you for transitioning and advocating for the boards on the call.
That's great. Well, and Ron, I want to go back to the first part of your commentary where you gave us a reference if we wanted to look up what the regulator. Can you repeat that just so that, because it's Callie, you might put it into the chat here too for
Sure.
participants.
It's supervisory letter SR. They're called SR letter 21-3. And what it actually means, here's the code the Fed uses. It's the third letter that the Federal Reserve issued in 2021. So that's how it gets 21-3. And you'll find it immediately if you make a Federal Reserve Board SR letter 21-3. And it's a good document. It's only seven pages long. So it's not verbose. And it's a good guide.
Good guidance. That is terrific. Well, why don't we take a polling question right now? We're going to try this again. And we're going to ask our participants here, if forced to choose, would your board prefer detailed reporting packages or more time spent discussing risk? Okay, let's pull that polling question up, Callie.
1 second, having a little bit of a tech issue. It'll be up shortly.
Okay. And Kathy, you've been quiet, but you've been active in the chat. I haven't acknowledged you. I'm going to give you time to sort of highlight some things before we wrap up.
Yeah. On that, I see Kathy's question in that about use of scenario analysis. It's something we touched on before, and Ron, you can relate to this in terms of your discussion with management. Is like, look, has management thought through like the different potential outcomes, like all that scenarios? There's a lot of that done in stress testing, in financial services, but just in general, like what, you know, these are the assumptions we're making. This is the planning we're doing, but demonstrating that they've thought through all those different scenarios is essential.
Yeah, so Callie, what do you think? Go ahead.
Go ahead.
No, Ron, you go ahead. She's still working on getting the polling question up, I think.
Well, the word I love that's used a lot when you talk about stress testing is plausible. And the reason I like the word is because, you know, no one's saying it's expected, no one's saying it's likely, but it's plausible. And the challenge that we get thrown every single time that there's a crisis is that it's these things were plausible, but they weren't expected at all, and they often referred to as black swans. Well, they aren't really black swans. They're really they are you know, deficient swans in the herd, but they're all white. They're not black. They're just hard to see. And so, in terms of scenario design, I really think that is the central discussion that the board needs to have around, well, have we thought about this? Have we thought about that? What would happen if? Nobody's saying it's going to happen, but it's like a reverse stress test where you find, well, what are the things that could actually kill us? Which systems, if they went down, would actually handicap us to the point that we could go out of business, rather than you know, come up with 1,000 things, some of which are not really that when they're quantified don't really have that much of an impact.
Yeah.
Ron, I'm going to just jump in on that for a second. I was on the Synovus Financial Board, and I went on during the financial crisis, and people said, why would you go on a bank board at that point? And I said, because I believe in the management and also the footprint that they had. It was a concentration risk issue that we had. But we use scenario analysis to start looking at what you're saying, the improbable or probable kinds of things. And two issues that we brought up and discussed first in the risk committee and then at the full board, and it changed our strategy and policy. One was with the first Trump administration, how it was going to be different and how geopolitical issues were going to need to be discussed. And so we did some what ifs there. And it happened, our first board meeting that year was the year that he tweeted about Boeing and the price went down. And then the second was about environmental issues in Florida, because we had a big footprint in Florida, and doing a catalog of what not necessarily residential or commercial that had flood insurance, because they did, but the issue of what happened to the groundwater if you have floods and the impact on the soil and so forth. And the only way we got those discussions and changed the strategy was through actually talking best case, worst case, what is likely to happen, and actually bringing in some experts. So I just think you both have done a fabulous job of outlining all the major risks that are out there. Right now, board should be talking about quantum, even though it's not here yet.
And Kelly, we don't have, there she is. We've got you back on the screen. We could hear you, but we couldn't see you.
Yeah.
But that's a great point, Kathy.
Yeah. Kathy, can I just pick up on one thing there? This is something Ron and I have talked a lot about too. When you talk about this scenario analysis and planning, at least in financial services for a long time, it was independent risk management that was expected to do the lion's share of that work. And it was a bit difficult to pull the business into like constructive discussions. And thankfully, that's evolved considerably over the last 10 years, so that you are getting sort of meaningful, thoughtful, fresh look at strategy, saying, look, do we really want this risk? Are we really making enough money on this business to warrant even being subject to that potential adverse scenario?
Yeah,
I think that's a really, really important point, Mark. It's something that I did have in my notes here. There's it's very, very important that the board focus not only on the risk, but put the risk in the context of the business. So they need to draw in the business. They need to draw in the first line to understand the impact of some of the risk proposals, risk decisions, the impact on profitability. What kind of constraints would it put the business under? What kind of risks is the firm actually prepared to absorb? It's not in the risk avoidance business. We all know that every business takes risks. That's how money is made. But making sure those aren't outsized and that they're controlled and that there's reporting about those risks, that if they go offside, it's possible to pull back from what was from the business as a whole. But involving the first line in these discussions is essential. And you're absolutely right, Mark. It's something that, to be blunt, it's something that in the financial services sector, the regulators do not care about it. The Europeans, actually, the ECB is more interested in the business model. The US regulators are interested in safety and soundness. They're not looking, I suppose you could say profitability leads to retained earnings, leads to capital, and they care a lot about capital, but they are more focused on things that could reduce capital than on creating things that would increase capital. That's a kind of generic problems that all the regulators in the US have. The Europeans have made an effort to try and overcome that, maybe not successfully, but at least they do talk about the business model.
Yeah. And
Mark,
one quick trick. Can I offer one quick trick? One quick trick for board members too is to if the chief risk officer is presenting, make them sit next to the CEO so you can watch the face of the CEO as the risk discussion plays out, because it gives you a good line of sight into how well connected they are.
Well, also a well-run risk committee will have independent meetings with the chief risk officer also, which I think is important without the CEO there. Just one other risk I'm going to bring up that you haven't talked, I'd like to hear more about. We've got huge supply chain risks, whether it's the tariff issues and vendors moving around, but also the Red Sea and the Strait possibly being closed. So that's another area that often it deals very much with strategy. Are you going to get the chips you need? Are you going to get whatever resource it is you need? And what are the alternatives to that? So any thoughts on that too?
Well, I think that, in some ways you're talking about scenario design or scenarios testing. Usually there's a proxy in history for something that you're looking at. I remember being responsible for a credit card portfolio in JPM in 2001. In 2001, employment was just about as robust as it is now. The economy was humming along. There were absolutely no problems. So we found it very difficult to model loss in the portfolio. With delinquencies going up, nothing seemed to happen to credit card losses because people always recovered. So what we did was isolated certainly metropolitan statistical areas, the MSAs, where there had been actually a recession, and to extrapolate those learnings to the larger portfolio. So if I were to break down a supply chain problem, I would look at prior problems with supply chain and try and say, well, now we understand how it happened there. If it happened nationally, what would happen? What would be the factors that you'd need to consider? That's just one technique that I think is helpful when you're looking at something that hasn't happened yet and that you don't have any history for on a national or global basis.
So I'm going to encourage, I saw Larry's got a question in the chat. We're going to open and address the questions shortly. So if others have questions, put those in. We're going to have a few minutes here. But before we do that, on that last poll, I'm curious, Mark and Ron, 90% said they want to have discussion and not the board packages as a way of kind of dealing with information. Does that 90%, does that surprise you?
Well, they've been listening to Ron and I, so they see the value in a robust discussion. So no, I'm not surprised. No, look, I'm not surprised at all because a risk package is boring. It's just unless it's well written and thoughtful and you're getting good context and there's a story there. Who wants to sit through and like sift through all these charts and stuff that Ron was describing? That's in financial services. I'm admittedly less familiar to what a risk package would look like at an oil and gas company. I think for me, that would be quite cool to read through. It's a different set of risks and lots more physical risk and sort of this shipping of oil around. So that might be interesting. But in financial services, the packages are a little dull.
Yeah, and I would say that the board is not a place for directors to receive lectures from management about what they're doing and how wonderful they are and how great or how difficult, how terrible the business is or whatever. They aren't lectures. They are supposed to be forums for directors to provide direction to management. And if you're just busy you're passively receiving information, you are not doing your job as a director, which is to direct management, to tell management what your expectations are and what kind of issues that you want management to be working on, because the board has no ability to do anything except direct.
Well, we have in the chat, Larry's asking, will reduce regulatory oversight / deregulation, e.g. the Fed, put more or less pressure on risk committees? Thoughts, guys?
I don't know. It depends. If some of this deregulation accelerates the pace of launching new business initiatives, I think then risk committees have to be prepared to put more time in to make sure they understand the implications for both strategy and risk of doing that. So that's the one thing that jumps to mind. The other point I'll make about in financial services, at least deregulation or downsizing of supervision, more so, is that it's a double-edged sword because you might get less of it, but you might also get lower quality supervision, which can put a burden on the firm if you have a lot of junior examiners who have grown up with this check the box exercise for risk. It becomes a less productive, I think, and interesting exercise.
Yeah, it's a cultural problem or cultural issue. And what I think what risk management would preach is that good risk management is a fundamental requirement in any firm. And if you think about regulatory requirements, you need to think about them as being the guardrails on an interstate highway. And if your car gets anywhere near those guardrails, you are in the ditch and you're actually going to destroy your car. But it does prevent you from going over a cliff. That's what regulatory guidelines are supposed to be doing. But good risk management is actually staying on the road. So if you're depending on regulation and regulatory requirements to drive your car, then in fact you're going to have a very unpleasant experience on the interstate.
Yeah.
A lot of firms actually, though, use the guardrails as their own limits. That's the limit structure. They'll just go to the extreme. Well, if you're running your capital regime according to minimum capital standards, most people would say that that's driving too close to the edge of the road.
Yeah. No, one quick one I'll add to that too, with that point about the guardrails is we had a lot of questions here at FTI when they said they were going to reduce enforcement of the Foreign Corrupt Practices Act. So it's like, oh, how should we respond to that? It's like, well, you don't suddenly shift your corporate culture to start bribing people, right? So it's sort of that law. If that law is why you don't do that, I mean, you really need to rethink the culture at the board level.
Can
Well,
I just
sure.
just one more
Go
quick
ahead,
comment?
Ron.
Because I
Yep.
don't want to sound completely naive. I think that the Basel III iteration of Basel III that was proposed by Michael Barr and which the financial sector really reacted against, I think in some ways that was too far. That actually pushed banks to overcapitalize in a number of areas, especially the very largest ones, that would have had a negative impact on the environment. So I'm not trying to be jingoistic and say always be less than the regulatory requirements. That, as it turns out, didn't happen. As you know, many of you who have followed that know that the reaction to the notice of proposed rulemaking was very negative. The current administration doesn't intend to follow those extreme versions, but the pilot that was put up by the Fed was extremely conservative, so conservative that it actually went further. It was like putting the guardrails on the road. So I just wanted to I didn't want to leave the impression that I'm a great lover of government regulation, and I think that the regulators were always right.
Well, and I just want to make a note here. Sharon Ingram, who does a lot of work on strategy with boards, she said she really liked the comment plausible focus, but one downside is if we only explore what's plausible, we risk preparing for comfortable, not the critical. So she's suggesting scenario analysis should include plausible, the perilous, and the nearly impossible. So I just thought that that was a great point Sharon, great point.
Yeah. The one reaction to that though, and when you're thinking about that scenario and then you look at those potential like hugely adverse implications, like, okay, well, what am I going to do about that? Like, am I going to invest in the control infrastructure I need to do well under that scenario? I mean, that starts to get very expensive. So I think it's good to have that awareness. But it's difficult to sort of try to hedge against those tail events.
Well, we have one other question that we'll take, and then I'm going to wrap this up by having Mark and Ron give us 3 key points, 3 key takeaways. Anne is saying decreased regulatory oversight will not tame the plaintiff's bar. If something arguably goes wrong, stakeholders will take action. So it's not a question, but it's a point, and any comment on that, Ron or Mark?
Oh yeah, absolutely. I mean, the door for litigation is always open, right? So I don't see the expectations on boards and their liability in these scenarios. I don't think changes at all if the regulators take a different approach.
Yeah, I would agree with that.
Okay. Well, and Kathy, I see you had one too. To the two of you, what's your view on wholly privatizing Freddie and Fannie Mae?
I don't have the expertise to comment on that one, really.
Well, having lived through Washington Mutual, which is, and I was there at the time.
Yep.
I actually think it's naive to think that the government cannot be guaranteeing all the mortgage-backed securities that are out there. It represents something like 45% of the entire housing market. So it seems to me, this is a very personal view, that it's basically a free ride to the owners of whoever ends up making that investment, because they're operating government guaranteed entities that simply cannot fail. So you get the upside, but you don't really have any downside as an equity owner. It's going to be interesting to see. I mean, the government has been trying for 10 years to privatize them, and if you look at our, debt, like the treasury market is $41 trillion. $29 trillion. But if you add MBS, then you get up to 41. So it is part of the government debt. And whether you have these so-called private entities managing the servicing for you, the reality is that the risk remains with the federal government. That is a very personal view, obviously not shared by all those that are trying to privatize. But really, the ones that would benefit are the private equity firms that bought all that debt at 10 cents on the dollar and want to make a killing. That's who's really behind it.
Excellent. So Mark, 3 takeaways. We've got a couple of minutes. We'll give it to you and Ron, and then we will wrap us up and close on time.
Yeah, so real quickly, the most important thing to me is making sure everyone's aligned, right? When you think of the board, risk management, the idea is to be driving profitable growth responsibly. And so if everyone's on the same page there, I think you can have much more productive discussions about the risks that are coming out of executing your strategy. I would emphasize, look, fill your skill gaps as a board member. Don't be shy about admitting what you don't know. Bring in consulting experts. That would be me to help you when you need help. And then lastly, with risk management, make sure they have the tools and they're investing in the capabilities they need, not just in the technology side, but on the talent side, because that'll really help you as a board to get comfort with the way risks are being managed.
Great. And Ron?
3 things. I would say, first of all, boards need to take control of the meetings, which means being specific on the agenda as to what they want. So simply having an item that says risk appetite is probably not sufficient. The chairman or the chair of the risk committee or whichever director is involved should be specifying, when you present this, we would like to see you address the following. So being more specific about what is being prepared for the meeting. And then providing active feedback to management. That would be another, from the perspective of the board. I think it's important that the board connect with the chief risk officer after the event and saying, management, this person in your management did a really good job of summarizing that, or they need to think better about how to communicate, or they didn't seem prepared, or they seem very prepared. So the credibility of the presenters and the quality of the material needs to be critiqued on an ongoing basis, or it won't get any better. And the third thing I would say is, let's not forget about the 3 lines of defense. I think most people on this call would be familiar with the Institute of International Accountants, Auditors, I should say, paper that was produced a number of years ago, outlining the role of risk management, the role of the business, and the role of audit. We haven't talked very much about audit. I think I mentioned it, but it's very important that the boards see a 3-dimensional view of risks if we're talking about risk management, not just the measure, monitor, and control aspect of things, but also the impact on the business and whether all the controls that are being put in place are actually working as they are supposed to, which is audit's role, is the assurance role. So the 3 lines of defense, just make a pitch for that as we conclude 15 seconds before the hour.
Well, excellent. And what a great conversation. I want to thank you all for joining us. As you see in the chat, we're going to have a recording if you missed some of it and all of that, but great discussion. Mark, Ron, Kathy, I don't know if you have anything else, but I wish you all well and thank you on behalf of the Board Risk Committee for being part of this. Kathy, you want to say anything?
I'll close out. Thank you again, Susan and Mark and Ron. Really excellent. I learned things and I thought it was very fabulous and lively. So thank you so much. Thank you for all of you that joined us today. And just to remind you, stay engaged with us at the Board Risk Committee and for future events and risk reports. And thank you for joining us. Have a great rest of the day. Thank you.